So today's session is going to be focused on the impact that we have seen with regard to retirement planning. So we'll have a chance to hear from Chris Stennett. He is with Saltmarsh Financial Advisors and a certified financial planner. He's going to tell us a little bit today about what that group is seeing in the market and what sort of advice and guidance that they're offering to our clients during this time. Obviously, lots of uncertainty, but they've got some great advice and guidance that they'll offer that I think will put you at ease and help you understand that keeping your eye on the goal is always a great focus to keep in mind. So with that, I'll just start with a couple quick housekeeping items before I kick it over to Chris to begin. Today's presentation will be recorded, so you'll receive a copy of that webinar recording as well as the presentation materials. We'll send those to you tomorrow via email, so check out those items. And in that email, we'll also include a survey, very short. It should take no more than a minute to complete. These webinars are relatively new to us. We've hosted events for many years, but this virtual format is one that we're testing out like many. So any feedback that you can provide to us as far as your experience, we would appreciate that. And I did mention earlier about our chat. One of the great things about Microsoft Teams, we have a chat feature. Please, if you have any questions during the presentation, feel free to put those in our chat. I'll be watching that as well as a few others, and we'll make certain that we address any questions toward the end of our presentation. We had a few folks send questions in advance, so thank you to everyone who did that. We'll certainly begin with those and make certain that we hit everyone's concerns today before we conclude. So with that, I will kick it over to Chris Stennett. Chris?
Thank you, Jamie. Now the awkward, I am going to share my monitor and I hope I am sharing the right part of it. So let's see what happens here. All right, that's step one and step two, and hopefully you are now seeing a slide deck.
Yes.
Beautiful. All right, that's exactly what I wanted to know. So again, thank you so much for being here. I know we have quite a few people on the line, and the topic that we're going to talk about today it's important. And so I thank you all for taking time out of your day to be here, to join us, to learn a little bit as we help you navigate retirement planning now that we have a new set of rules. So before I get deep into the presentation, I do want to start just with an introduction. As Jamie mentioned, my name is Chris Stennett. I'm a certified financial planner, and I'm also a financial advisor here at Saltmarsh Financial Advisors. We are an affiliate of Saltmarsh, Cleveland & Gund. As you can see here on the screen, our firm it's unique. We have your standard accounting practices, audit, assurance, business valuation, but some of the other practice areas at this firm, I'm just so thankful to have. If you have worked from home for more than 1 second, you know our IT team deserves all the love in the world. They have done a fantastic job, and just to be able to have that in-house is tremendous. This change, from coronavirus, COVID-19, it was real and it was sudden. And not only are us as employees, but our clients were immediately impacted. And there were a lot of clients who have leaned on Saltmarsh to help guide them, whether it was community banks and credit unions, turning to our financial institutions group. We had our audit team proactively contacting clients to discuss the PPP loans, the small business loans. So we hope that we have done a fantastic job in just letting our clients know that we're thinking about them, we care about them. For the last 3 months, we have only dealt with uncertainty and change. And new information just keeps coming that honestly, it's really hard to keep up with. So when I sat down and started thinking about what will this presentation be, there were two things I really wanted to talk about. First and foremost is the CARES Act, which is a direct relief act from the U.S. government as it relates to the hardships experienced with COVID-19. So for the first half of this presentation, we're going to talk about the CARES Act and what are some of the important pieces of the CARES Act that apply specifically to individual investors, retirement account holders. Within that, we'll also talk about how the stock markets have done in the last 4 or 5 months, because some of what we're experiencing here is unprecedented. Not everything. Now, the second half of the presentation is going to be more centered around what we do, what advice we would give you, the advice we're giving our clients to help navigate through this uncertainty. So, as Jamie also alluded to, we have a few questions that were submitted to us ahead of time. I am going to take those first at the end of the conversation today. We will then have time for audience questions. Hopefully we can get to all of them, but if for some reason we can't, please reach out to us. We want to make sure all questions are answered. So COVID-19, coronavirus, as I mentioned, it changed almost everything about the way that we do business right now. And fun fact, the name CARES Act is the Coronavirus Aid, Relief, and Economic Stimulus Act. And it was signed into law by the president March 27th, 2020. And in it, there are a lot of provisions, some for individuals, some for business owners, and it is over 880 pages long. So it took some time to kind of comb through it all and cherry pick the stuff that makes the most sense for our clients, the investor clients. So I want to talk about what those are. If there are topics that are not on this list that are on your mind, type about them in the chat and we can find a way to get some answers to you before all is done here. But the most highly publicized rebate was those recovery rebates, almost like a personal stimulus check. These recovery rebates were just an advance of credit against your 2020 taxes. The amounts varied whether or not you were an individual filer or a joint filer, whether or not you had kids. It also varied depending on whether or not you had filed your 2019 taxes. Because there are so many people on this call, the resource I will give you is the IRS. And go to the irs.gov. While they might not always have great technology, their website is doing a great job of keeping us informed, and I'd recommend everyone check it out. So the second important relief for individuals is the $300 above the line charitable deduction. If you are not itemizing and you are planning on making a contribution to a qualified charity, you can give $300 this year in 2020 and have that reduce your taxable income. So it's a great way to give if you were already planning on giving, but keep in mind that's for those who are not itemizing. What the CARES Act did to encourage giving was through this second piece, the charitable giving limitation change. So individuals who do itemize, there previously was a limitation on how much you could give. Based on whether it was giving a stock, security, or giving cash. But for the most part, it was a percentage based on your adjusted gross income, 50, 60%, depending. Now that percent has been completely eliminated. So it's effectively an unlimited opportunity to give to charity. Now, one thing I need to be really clear on, I am not a CPA. If you are interested in doing a gift like this, please contact your CPA. They'll help guide you through it. What I think, though, is probably the most important individual relief act is the waiver of the required minimum withdrawal. So the act waives all minimum distributions for the year of 2020, regardless of whether or not you were impacted by the pandemic. If you have taken your 2020 RMD out, you'll want to speak to your tax advisor or financial planner to talk about maybe finding a way to put that back into your account. Because as you know, minimum distributions count towards your taxable income. So if I had a minimum distribution this year, $70,000, then that $70,000 goes on top of my taxable income. But we don't have to take it this year. And that can be really important from an income planning standpoint. If you're a retiree and you haven't taken your minimum distribution, or you have, but you might want to claw it back, you should really consider sitting down with someone and mapping out what would be the best use of your money. As a very quick example, I can tell you I had a client who did not do her minimum distribution this year. She usually lives off of it, but instead we did not take it, and we took the money that she needed instead out of a separate investment account, a taxable investment account. We were basically able to shift her tax liability by a substantial amount. It's certainly substantial to her. So with this new rule, this new requirement, there are ways for us to change your income tax profile in ways that didn't exist January 1, 2020. So this one's really important, and one that I would recommend you consult your advisors on. Some of the other that you should be aware of revolve around taking money out of your retirement account, these last two. And I will say taking money out of your retirement account is not advisable. It's what we would consider something you should do as a last resort. But we're in some unique times, and that may be all you have. So through the CARES Act, you are now allowed to take a distribution of up to $100,000 or 100% of your vested account balance without paying a penalty tax. A penalty tax applies to anyone who is under retirement age or under the age of 59 and a half. So if you're under 59 and a half and you took money out of your account, you would generally owe a 10% penalty on top of the taxes you would already owe. Through the rest of this year, that penalty will be waived as long as it is for a qualified distribution. Now, the term qualified distribution does mean something. I'm not going to go into the specifics of that today because I believe we could probably spend an entire webinar on it. Just know that if you are interested in taking that distribution out, you want to know what is qualifying, you can certainly find out through the IRS website or contact someone here at Saltmarsh because we have that information and can get it right to you. But the other component that changed here with the early withdrawals is custodians are not required to withhold money for a prepayment of taxes. So imagine you are 60 years old, you're not an early retiree any longer, and you take money out of your account. Well, if you took your money out of a 401k account, usually that 401k provider has to withhold 20%, send it to the IRS as a prepayment of your taxes. They're not doing that right now so that you can get as much money possible into your bank account to help to get some relief from some of the hardships that you're experiencing. So it's an important change. It might not be everything that we need, but it's something. And the last piece here is the change to the retirement plan loans. Previously, if you have a retirement account that allows you to borrow from it, the limit that you could borrow was $50,000. That amount has been increased to $100,000 or 100% of your vested account balance. And if you have an outstanding loan, your payments can be halted through the year and essentially pick back up January of next year, again, to provide a little bit of relief. So these are the important changes to retirement plan rules that every investor should be aware of. What I want to talk about now is the COVID-19 specific impact to the markets? What have your investments done? When we see an event of this magnitude, it can shake investor confidence across the board. Volatility increased in every stock market. Economic data on unemployment reported an unprecedented number of new weekly claims week over week, and it's just only getting worse. People all over the world are being told, stay inside, shelter in place, and that's having some economic ramifications. Restaurants have had to adapt. They're shedding their staff, they're changing their business model, they're cutting their food supply orders, and that has an impact in other areas of the supply chain. So you've got farmers now with a glutton of excess food, and they're unlikely to find another buyer for it. Likely will be wasted. And then you've got retail shops. Shoppers right now are forced pretty much to go online. Brick and mortar retailers have been struggling for years. Lump this on top of it, and there is no real way of knowing what will happen to the JCPenney's and the Neiman Marcus's of the world. What will their business model look like in the future? So with all of these bad things happening, it is expected that the stock market should be going down. I mean, negative events, stock prices going down, that's really a sign of a functioning market. In fact, I would actually be worried if markets were going up through this pandemic. That's what would give me some pause. There are many, many things about this pandemic that is unprecedented. The job loss, the amount of money that we are printing, and the trillions to stimulate our economy, the long-term health effects of this on our working hospitals and doctors. There are things we are absolutely worried about. We don't even know if we're at the starting line or the finish line. Understand, however, though, the economy and investment markets, they're not the same thing. They're not mirrors of one another. So the chart that we're looking at on the screen, it represents the same stock index, the Msci All Country World Index, which is just a broad measure of global stocks. How have they performed? Well, the top chart shows the relative performance from March 31st, 2019 to March 31st, 2020. And as you can see, there was a pretty smooth ride until the beginning of 2020 and an immediate drop. Sometime around March 27th, the market did jump back up. If you were paying attention in the last slide, you probably know why that was. But if all we ever focused on was the short term, we'd lose a little bit of the bigger picture. So the bottom chart is the same market, the same index, but pulled out over a 20-year period. And you can see highlighted in blue, the 12-month period. Now run a line from the lowest point of the last 12 months, across the screen, and you'll notice that the prices, the values never reached even close to where they were in 2008. So yes, markets have gone down, but they haven't gone down by an unprecedented amount. And I think that's important to know. Now, markets go up and they also go down. And commonly, they tend to go up more often than they go down. So what you're looking at on the chart here, represented in red, is all of the periods when the S&P 500 was down 10% or more from its recent high. And this is dating back from January 1926 to December 2019. We can see that the good times in blue have been disproportionately disproportionately longer than the bad times, but the bad times still occur. And they don't vanish right away. I think back to the Great Depression. It was down 83%. That lasted for 34 months. Even what we experienced, back in 2008, 16 months. So yes, the market will go down. It may stay down for some time, but the belief is in growth. Now, my wife hates me for saying this. I actually framed this chart and put it in my daughter's rooms. It sounds crazy, but that's how important I think this chart is. It's a very good visual for life and for investing. Discipline and perseverance matter. So in order to achieve your goals, you're going to navigate adversity, you're going to navigate uncertainty. And I give my girls the same advice I give my clients. Stay the course, have a plan, be patient, focus on what you can control. So yes, the market has gone down, and yes, it will continue to go down again. But this isn't unprecedented. It's happened in the past. And the only way that you're going to be able to experience those market returns, well, two ways. Way number one, you could time the market, which means you would have to sell out at the exact right time when prices were high and wait. And eventually, when prices got to the bottom, you could buy back in. So far in history, no one's been able to do that, but maybe you're the one. I think though more appropriately, and the way that we guide clients is to just stick to your investment plan. It's a plan that was built thoughtfully in the beginning. We know markets will move. It's the natural part of investing. Corrections do happen, but if you can maintain discipline and you have a well-built plan, the only way to capture these large growth periods is to have, unfortunately, experienced some of the downturn along the way. So this is where we shift to the second half of the presentation. I want you to understand what you can do to your portfolio today to make your peace of mind a little easier, to make your life a little easier. You, as an investor, will continue to be faced with challenges. It's just the nature of the industry. The best thing that you can do, though, is to follow these steps. Focus on what you can control. So I'm going to talk about each of these 5 points here in a little bit more detail. But this is what I would say every investor needs to hear. This is what should be guiding your investment plan, whether it was built by you or built by your advisor. Focus on what we can control. And the first thing we can control is our risk. We need to manage risk in line with our return. So in order to make money in investing, you have to bear some risk. High risk investments need to offer high returns. If they didn't, no one would put their money into them. So this slide gives us a bit of an example of how that works. On the left-hand side, you see 5 different portfolios. Starting at the bottom, a 100% stock portfolio. That is the most aggressive of the portfolios. All the way to the top, the 100% treasury bill portfolio, the most conservative. So quarters, the most recent quarter and the 1-year return, if you look at the 100% stock portfolio, you can see that it is down. And it is down by a lot compared to the safest portfolio. But as we look down in time and we look at the 10-year line, we can see that 100% stock portfolio has seen returns well above what the 100% treasury bill portfolio saw. So comparing risk, matching risk, to who you are, this is a big piece of investing. Your advisor may not take the same types of risk that you take, but this is your money, so your risk is what matters most. Had you been in a 100% Treasury bills portfolio over the last 10 years, you wouldn't have lost any money. The problem is inflation is a real thing, and it's eating up the purchasing power of your dollars because you're only making about 0.5% every year. Well, cost and goods and services, they grow at a rate closer to 2%. So your portfolio's risk level, it needs to be directly compensated by its returns. Just because you're taking risk doesn't mean you have a high returning portfolio. In fact, you could have an unusually risky portfolio and experience moderate to low returns. Well, that's an area where maybe we need to look at the underlying investments, see what's going on there. So it's not just taking risk, it's about being properly compensated for the risk. And we'll look at that a little bit closer right here. Now, for those of you who have been to a DFA or a Saltmarsh Financial Advisors investor meeting, you've seen this slide in some way, shape, or form. This slide represents the major investment vehicles available to U.S. investors. The first one being cash, that's represented by the Treasury bills line in yellow. The second being bonds, represented by the gray line, long-term government bonds. And then the third being stocks, represented by the top two lines. And what this slide is saying is, imagine you had $1 in 1926, and you invested that $1 into each of these portfolios, we'll call them. How much or how little did that dollar grow from 1926 to 2019? Well, you can see if you were just investing in cash, that $1 turned into $22, barely keeping pace with inflation. The bond investor was able to see a reasonable return of $175, where the stock investors far outperformed both. This chart just illustrates that there is a real role stocks have in creating wealth over time. People rarely get rich by investing in bonds, but bonds have an important place in a portfolio. US stocks aren't all the same. That's why we see a small cap and a large cap on this screen with two different values. Consider the performance of the small cap stock, the one in blue, versus the large cap stock, the one in orange. Small US companies have outperformed large ones. And that may be a surprise, but large US stocks actually carry less risk than small US stocks. And I think a lot of you know that intuitively. So think about it this way. Imagine we were in another Great Depression right now. Which burger company is likely to weather the storm? McDonald's, a company that's been around forever and is huge, or the up-and-comer, Shake Shack? Well, in times of great market upheaval, it's pretty likely to assume that Shake Shack would be the one that would not make it through. But think about it in the other way. In a positive economy, which of these two companies is likely to triple their market share? The large behemoth that is McDonald's, or the newcomer, Shake Shack? It's much more difficult for a large company to 3x its return than it is for a small company just because of their relative size. So to invest in small companies gives you a better potential for growth, but it also carries a little bit more risk. But if you just looked at this chart, you might say to yourself, well, Why don't we all just invest in small US companies and call it a day? Would that work? Well, unfortunately, no. That wouldn't be advisable. So think about what businesses have been hurt most by COVID-19. The smaller companies. Small companies are important to have in a portfolio, but they must be balanced with other asset classes. When people ask me, how do you even know what a stock's price? Who comes up with that? Is that drawn from a hat? Is that board meeting, shareholders discussing what is happening there? And our view on it is, well, it's really pretty simple. We live in a world of information. You have a phone, a computer screen that you're watching this on, and access to information in a way that we really have never had before. And the stock market is really just an information processing machine. It's taking all of the available information about a company from every imaginable source and putting that together with buyers and sellers. They start to find an equilibrium between price. As I've heard it called before, it's really a perfect disagreement between buyers and sellers. So not all market participants process the information the same way or come to the same conclusion. Consider it this way. Let's say I wanted to buy 1 share of Apple stock. Well, for that trade to occur, I need to find someone willing to sell me that share. I need a willing seller and a motivated buyer. And in order to exchange the share for money, I have to give them a reasonable amount of money, at least what they deem reasonable, to accept the transfer. Now I'm buying this stock because I want it. The seller's selling it because they don't want it. We have access to the same information. Just because we have the information doesn't mean we believe the same. So it's something that's really important. It's something that I like to talk about. So investing in stocks is important. Investing in US stocks, not only large, but small. There's value in both. That's all well and good, Chris, but I think what I'm going to do is invest in something safe. Well, safe can mean a lot of things to a lot of different people, but one prevailing trope in finance is that utility stocks tend to be the safest stocks. So your energy companies, your waterworks, utilities, those tend to be safe havens, defensive positions when US stocks experience tremendous volatility. Then nature happens, and it can really mess things up. So this is the stock price of PG&E. PG&E is a utility company in Northern California, and at the time, Northern California was just reeling from dry conditions and a drought. At the end of 2017, a series of wildfires broke out in Northern California, and it turned out to be PG&E's fault. And their share price dropped. And you can see on the chart here when that share price dropped. Then for about another year, the share price bounced back and forth until the Camp Fire happened. So the Camp Fire became California's deadliest, most destructive natural disaster in history. This was also traced back to PG&E. So concentrated positions in a single company can create a lot of trouble, even if you think that the company is a fairly safe investment. Some of these things are just beyond our control. Think throughout history, where were the darling sectors, of yesteryears, and how are they holding up today? I mean, we had Enron, WorldCom, BP. That's a big one up in the Pensacola area. How did their stock price do? Even banks in 2008. All previously stalwarts of the American economy, now investors aren't sure where to put their money. There's another reason why I'm mentioning this. A lot of employers inside of their 401k offer company stock. And oftentimes employees working for that employer forget to diversify that stock. If that company goes under, which did happen in Enron, not only did the company go down, the paycheck that the worker was receiving is gone. And that 401k they were invested in, well, because it was 100% in Enron stock, it collapsed too. So spreading your risk out, that's a strategy that we call diversification. And it is crucial to meeting the long-term goals and navigating uncertainty. So this chart starts to talk about why would someone diversify. It represents the total market cap, the total ownership of stocks across the globe from 1990 to the end of 2018. And we could see that in the 90s, US stocks only accounted for about 45% of all stocks. As the years have passed, the US has taken over a larger percentage of that total market cap. But now look at emerging markets. You might not have thought much about them in the 90s, but today their presence is undeniable. And when you're building a long-term portfolio with, trying to navigate through uncertainty, managing risk is important. So having investments that are not correlated, they are diversified globally, it's just a fantastic way to manage risk. If you had a portfolio that excluded developed markets and it excluded emerging markets, it means that that account and its performance is predicated on one country. But it also means that you're missing out on 50% of the return opportunities available through the other markets. I wonder how many times in recent years was the US stock market actually the top performing? Well, this chart's going to tell us. Look down the left-hand line of the screen. The very bottom in blue is the US. When you're looking at the numbers on the chart, the only thing you really have to know is whenever a box is highlighted, that was the highest return for that year. There is a randomness to returns that cannot be predicted. So if you're going to invest 100% in US stocks, you're allowed to do that. Just know that your portfolio would have been the top performer one in the last 20 years. So not only will having global equities in your portfolio reduce the risk, it's going to increase the probability of capturing higher returns. Now, this is in developed markets, but the same is true for emerging markets. And I bet you'd be surprised some of the countries that are considered emerging. The two that stand out to me, China and India. I think half of the world's population sits between those two countries, and they're represented as an emerging market. Even investing 100% in China, risky, I know, would have only gotten you the best performing portfolio 1 year out of 20. Thailand did better. So emerging markets have value, but they're not going to be the emphasis of your portfolio. They're going to be likely a small piece of it, a way for us to diversify risk and potentially capture higher returns, knowing that a lot of these countries are still up and coming developing nations. and at some point will be reclassified as developed, and new countries will step in as emerging. So many investors, although they may prefer to keep most of their capital close to home, you could pay a high price in terms of lower diversification and missed return opportunity. One other piece that's important when you're diversifying your portfolio is bonds. Bonds are an instrument of really risk mitigation. They stand sort of in contrast to stocks. And typically, bonds are going to be used to dampen volatility. I've always used this expression. Adding bonds in your portfolio, it can be like giving Benadryl to a Jack Russell Terrier. It's meant to tamp it down, not eliminate it entirely. Fixed income is exceptionally important when markets are not doing well, and they're not doing too great right now. So if stocks continue to go down, at least you have a part of your portfolio in potentially positive returning investments. But volatility isn't the only dampener here. Bonds offer liquidity. If you're a retiree in a 100% stock portfolio today and you need to take money out of your account today, you're going to be forced to sell something you don't want to. Having bonds in the portfolio gives us another option, something else to sell to fund the money that you need to live the life you want to live in retirement. Bonds also pay income typically. There's an income coupon with a lot of bonds, so that even if market returns aren't doing well, there's still some flow of cash being generated in your portfolio and maybe even being reinvested to buy more shares. Bonds can also have a tax-sensitive approach. So a way to grow your investment accounts without paying as much in taxes, or in some cases, not owing any taxes at all on the growth. So what type of bond is right? That is relative. It really depends on the investor, their goals, their risk tolerance, and their time horizon. How much time are we really talking about between now and when they want to use the money? Even further, how much time are we talking between now and when they're never going to be around to use the money again? That's how we handle diversity. We make sure that you have a portfolio that contains options so that when things go sideways, we have other avenues to pursue to help capture the returns that you're looking for. Now, the fourth piece, the fourth area of focus is staying disciplined. This is very, very, very hard to do because we're human. The idea behind investing is to buy low and sell high. Yet, most of us operate emotionally, sparked by reactive decisions and oftentimes doing the opposite. And I can remember this vividly in 2008. One of the first jobs I ever got in the finance world was manning the phones at a 401k service provider. So all day I was receiving calls from 20, 30, 40-year-olds about how stocks are doing in 2008 and what should I do about my investment portfolio. Well, these are people who are decades away from retiring and even further away from their date of death. And they're saying they want to move out of the stock market at its lowest point and move into something safer called cash. Well, those that did, they locked in the losses. And as the markets climbed back up, they were often late to the party. But had they stayed disciplined through those rising and falling markets, they would absolutely have increased the potential for the long-term returns. Now, this is an emotional cycle, but markets tend to operate in cycles like this as well. And don't feel bad if you've ever made an emotional decision. We're all guilty here and there. But one of the primary jobs of a financial advisor is to help talk through that emotion to really see if it's got a sound foundation or if we're better holding the course. So as an example, markets have rewarded discipline. This chart shows us the growth of a dollar from 1970 to 1969. And if you ignored all of the headlines, just looked at the chart, at the graph as it grows, you could see it's a positive upward sloping chart. But along the way, there were many different events in history that caused the markets to move here and there. So news and financial commentary can influence your view of investing. Without a strong investment philosophy, people follow the advice of people they know. Sometimes those people don't know all that much. Another thing to consider is, well, what is financial news? Financial news, it's designed to evoke emotions. I mean, it is there to get eyes to the television or to the phone so that they can sell advertising. I've used this example before, but I think it's hilarious. Are you familiar with Mad Money? The guy has a great haircut like mine, rolls his sleeves up to his shoulders, screams, yells, presses buttons. Jim Cramer. Well, the longtime show producer for Jim Cramer, Susan Krakauer, before she worked at Mad Money, she was an executive producer at the Jerry Springer Show. That's where she came up with the idea to blend financial news with salacious talk shows. So always be mindful of who's giving you the information. One more area that reacting can hurt performance is by just getting out of the market, even for short periods of time. And I think this chart's really interesting because it illustrates the performance of the S&P 500 having missed X amount of days. So imagine you took $1,000 in January 1 of 1990 and put it all into the S&P 500. From 1990 to 2019, that $1,000 turned into just over $17,000. If you missed the very best day of investing, just one day out of all of those years, your return was dropped by almost $2,000. You missed 5 of the best days, talking about now an $11,000 portfolio versus a $17,000. And you missed 15 of the best days, and now you've lost almost $10,000, just over. So being in the market matters. I don't know if anyone realizes this or not. April 2020 was the best month for stock returns in 30 years. But you had to have been invested in April to have experienced that growth. And I know that's not the case for everyone. So discipline matters. Oftentimes these high growth, high return days happen in the middle of some really bad ones. So hold the course. The last bit of advice, guidance that we would give our clients, and honestly, that I'm giving you today, is to manage your costs, manage your expenses. What I do for a living, I am a financial advisor. My services aren't free, so it's not irrational to pay an advisor a fee. But there is a difference in the rate you pay your advisor and the services you get from that advisor. You might be paying 2 advisors 1% each, but the advice you receive may be completely different. That also holds true for some of the costs within portfolios. These transaction costs listed on the screen, almost every one of them is avoidable. Now, if you work with an advisor who doesn't make commissions, you don't have to worry about that one anymore. Or an advisor who doesn't work with loaded funds. They use what we call no load funds. Advisory firms are working harder and harder to minimize the cost to do trades. I think we will see a $0 future for all trades. We're not there yet, but that's something that we could always look at as a potential driver of cost. Surrender charges are another. You know, the investment that you're in, does it have a penalty if you get out of it too soon? Well, what if you needed to get out of it? Was that the best place to put your money? So it's important to know where those charges are. There are also costs associated with investing. I mentioned an advisory fee, but even being in a mutual fund has what's known as an expense ratio. And there are some astronomically high expense ratios out there. I'm not saying that a high ratio is bad. It's good if they're making you a lot more money. If they're not, then it's probably not a good thing. And lastly, an annual variable annuity fees or plan fees, like 401k plan fees, those exist. You might not be able to control them, but there are products out there that you might be able to use to control them. So definitely be mindful of your expenses and be mindful of your taxes. Look, we're a tax organization here. One of the reasons I joined Saltmarsh is because there is a belief at this firm that investment decisions are tax decisions. I mentioned I'm not a CPA, so when I give a client advice and it has a tax ramification to it, if I don't work with that client's CPA or I don't consult one of our internal CPAs, then I'm really not giving my client a full recommendation. I'm really only giving them half of the recommendation, the non-tax half. And taxes can impact returns. So be mindful of how your money is invested, what types of accounts are invested, and what investments are held in those accounts so that we can minimize the tax impact of those holdings. So that's it. I mean, it's a lot, but at the same time, it's not everything. There is so much that could be talked about here. What I do want to leave you with, though, before we get into our questions, is, look, the coronavirus, I don't know what's going to happen in the future. I'm very thankful that I'm at my office wearing a tie. Yeah, I do have pants on. I don't know why everyone keeps asking me that. I'm thankful to not be at home today. But I don't know what the future holds, and I don't think any of us really do. So uncertainty is going to linger. And I can't promise that you will always make money in your investment accounts, but I can tell you that if you follow the principles that we laid out, or you work with an advisor who uses those principles, your probability of success and your probability of reaching your financial goals goes up dramatically when you have a process. When you don't, you're beholden to emotion. And unfortunately, emotion, it can be a dangerous thing. It causes us to make poor judgments sometimes, can kind of cloud our larger view. So I'll leave it at that. Now, I do have some homework for you. So after today, you've heard a lot about Saltmarsh, about those key provisions in the CARES Act, but you might have more questions. We're going to ask questions here in just a minute. But in the meantime, what I want each of you to do is take a look at your income plan for 2020, especially if you are 70 years old or older and you're subject to minimum withdrawals. The changes that occurred this year happened in March. We did not know about this in January, but there may be some ways for us to go back and amend some decisions and put money back into your pocket, or at least save you some taxes in the long haul. The second thing I would have you do is ensure your portfolio matches your risk tolerance. The markets went up basically for 10 years straight, barring 2018. It did go down a little. Well, when the markets go up for that long, it's hard to know exactly where your risk tolerance is. When the markets go down, you get a much better feeling for how impacted you feel when you look at your account statements. So if you have been bothered by your account statements recently and you feel like you don't have a plan, or maybe there isn't an alignment between your portfolio's risk and what you're comfortable with, that needs to be amended. And it's okay to do it now. And lastly, take inventory of your investments, the taxes and the fees that are associated with each. And I'll leave you with a quote. In fact, I've got 2 quotes here. Buffett, successful investing takes time, discipline, and patience. No matter how great the talent or effort, some things just take time. You can't produce a baby in 1 month by getting 9 women pregnant. Also, the important thing about an investment philosophy is that you have one you can stick with. So I'm going to turn it over to Jamie as we begin our Q&A session. Actually, you know what? Instead of turning it over, Jamie, I'm going to, because I have a series of questions here already, I'm going to go ahead and start answering the 2 that I have. And then if it's okay, I'll ask to see if we have any more.
Perfect.
Okay. So let's see. I'm going to leave this. I'll leave my picture on the screen here so you guys can capture my information. I can switch back in just a minute so you can see my beautiful face, but there it is in all its glory. One of the questions I got was retirement planning response strategies by career stage. So what would you do if you were closer to retirement? What would you do if you were further from retirement, with regard to all this volatility? So let me first say I am speaking in generalities here, because you're not my client. I have no idea your total profile. Younger individuals should be making fewer changes to their investments. As long as you have set your asset allocation up in your 20s and 30s, you could likely keep that allocation well into your 30s and 40s. It's really as you get closer to your retirement date that shift needs to begin. We tend to say about 10 years or so away from retirement, you go from maybe having a 100% stock or a 90% stock portfolio. Maybe you back that down 10%. So now you're a 80% stock portfolio and a 20% bond portfolio. Really, the reason is we have no idea what the market's going to look like when you retire. But if you are one of those Murphy's Law's children that got their retirement plaque handed to them on Black Monday, that's just really unfortunate. And if you were 100% in stocks, you're going to be selling stocks at a time you shouldn't be. So the most important thing is not being 100% in equities right before you're about to take money out of your retirement account. Anything else outside of that, it's more personal driven, how much risk you're comfortable with. But an advisor can always help you with that. If that didn't answer your question, that email address down there, send the question again. I'll make sure I get it answered better. The other question I got was details on the effect of taxable income of withdrawing your IRA or 401k. So this is going back to the CARES Act. And I'm assuming the question is, what if I took money out of my account? Say I took $100,000 out of my account. What is the impact of that? Well, distributions are going to be included in your income ratably over a 3-year period. So let me use $9,000 as an example. Sorry. So you took $9,000 out of your account in 2020. You would report $3,000 in income on your federal return for 2020, then $3,000 for 2021, and $3,000 for 2022. However, you do have the option of including the entire distribution in your income for the year it was distributed. So you could technically take that $9,000 all at 1 year, all at the first year if you wanted to. But that is, if funds are not paid back. If you took the $9,000 out, but you did not return it within 3 years to your account. So the question actually may be, what happens if I did pay the money back, but it might have been a little later? So same example, you receive that $9,000 distribution in 2020. You include the distribution amount in income over a 3-year period. So I said $3,000 extra income on 2020's taxes, 2021's taxes has $3,000, and 2022's taxes has $3,000. You choose to repay the full amount to an eligible retirement plan in 2022. So that $9,000 has been completely put back. Now you can file an amended federal tax return for 2020 and 2021 to claim the refund of that tax that was attributable to you, but that the distribution kind of negated. So I hope that answered your question, whether you're paying the funds back or not. Keep in mind, we do, in fact, I'm going to get us right to this next page. This COVID-19 resources hub that we have has been phenomenal. And if you have a question that I didn't cover today, if it's not a financial advice specific question, this is a great place to go. saltmarshcpa.com/COVID-19. It is our resource hub, and on the hub, you can even send messages to our CRRT team. So they are, in fact, I've used them a couple of times. If you have questions, start there. Start with your internal contact at Saltmarsh. We may go there. It is just a fantastic resource for individuals and employers. So those were all the questions I have. There was a third question, Jamie. The third question was about the taxation of the federal stimulus deposits. What would be the tax liability of future federal stimulus payments? The short answer is I have no idea. I don't think any of us know yet until these things are actually rolled out and determinations are made, that they would be guesses. And I don't think it's fair to guess.
Hey, Chris, we did get one question in our chat around a point you mentioned earlier. Did you say that $1,200 per person economic recovery payment is an advance on your income tax refund? Can you elaborate on that?
Mm-hmm.
Okay.
Yeah, and what you can do, because it's also non-taxable. I know we've got some tax folks on the line that know this way better than I do. But the IRS.gov website goes into detail about what it is. But if you can see who asked the question, we could also have one of our CPAs reach out and help define it a little bit more, since I'm not the expert.
Perfect. We did have Stacy Everhart. She did want to know what's considered younger. You mentioned earlier, I think maybe 20 to 30 was that age range. Is that what you had in mind when you said those younger with their investments? Yeah.
Anyone really, and it's going to hurt some people's feelings. Anyone younger than 30 is young. If you're 30, if you're above the age of 30, you're not as young anymore. Yeah. There are 18-year-olds, the interns that we had in here too, not too long ago. So younger investors are going to typically be your more aggressive investors. Your 30 and 40-year-olds could be just as aggressive as your 18 and 19-year-olds. It's really once you're about 10 years out from retirement. So that's more so the 60-year-olds, 50 and 60-year-olds of the crowd that need to be really mindful of their allocations, percentage stock to bond at that point.